Hi everyone, I am Sarah and welcome back to Brick and Mortar. Today I am thrilled to be joined by somebody whose name carries real weight in the New York City investment sales market, Faraz Cheema. Now, if you don't know Faraz, he is a seasoned real estate professional with more than 13 years of experience advising clients across capital markets and complex conversion projects. His career spans multiple respected firms, and he brings both hands-on transaction expertise and a strong academic foundation. So, whether you're an operator, an investor, broker, or just someone trying to make sense of today's CRE landscape, Faraz has a deep pulse on the New York City market, a sharp perspective on current trends, and a gift for breaking down what actually drives profitable decision making in this environment. Today's an episode of Brick and Mortar that you definitely don't want to miss. Great. So thank you again, Faraz, for being here. The first question that I wanted to make sure to cover is your background. So I know that you've been in real estate for over 13 years. Can you tell us a little bit about your background?
Yeah, so I kind of did a reverse of what brokers typically intend on doing. I come from like a family office background in the DC MSA. Um, Long story short, because I've said this enough times on podcasts and LinkedIn stories, um, but basically my dad was a retail operator who would lease space and then, instead of like paying a landlord, he would buy spaces. We'd buy pad sites, strip centers, whatnot. And then during the '08 recession, due to our business and how successful it was, my dad's the largest private check cashing operator in Maryland, so our inventory is cash. We would buy limited service hotels like pennies on the dollar. Then we were buying bigger shopping centers like 50 to 150,000 square feet. We sold off some of our smaller stuff, which was like, needed for like development sites, and developers would pay us top dollar and we would 1031 them into, good location, high cash yielding assets. You know, we typically, like, unlike New York, where I feel like most people buy on the appreciation basis and then cash flow second, our strategy was we will buy cash flow first, but always in a good location for like, in case we have to exit, and they'll sell at a high appreciation, maybe for development or whatnot. So at the peak, our retail portfolio is now about like over 900,000 square feet. Our peak hotel portfolio is about 800 keys. Pretty sure we winded that down to like 500 keys now. We're hovering around 200 units of multifamily. Not last summer, but the summer before, we got into our first Class A office building in DC. Um, we're one of three partners in the deal, equal share for the most part. We bought a 483,000 square foot office building in Tyson's Corner, 7 acres. The play was there is, look, it's sitting on 7 acres, great land, like, where it's located. But look, like, we bought it, if I remember right, it was either 56 or 58% occupied, 10% cash on cash yield, in place. You're buying like at 76 bucks a foot versus peak evaluation, which was like 120 million, which is pretty sure that's over 200 bucks a foot. But let's get the calculator out because I am not a human calculator. So
I love that.
120 million divided by 483,000. Yeah, 248 a foot. Okay, so I was definitely right. It was over 200 bucks a foot. But most people who are on the principal side don't go into brokerage. Usually they do that
Mhm.
in reverse. They go into brokerage, then they go into, acquisition, asset management, start their own thing. I did it because I was getting out of grad school. I have my master's in real estate at Hopkins. Um, and I wanted to get out of my dad's shadow.
Mhm.
And it actually kind of happened by accident. Like, first, I only got licensed because, look, like the assets we're buying, at the time we were buying like 10 to 20 million. Now we're buying anywhere from like 10 to like 50 million. But, like the smaller owner use deals or like the value add, like let's say anything sub 5, sub 10 million, usually there would be a co-op. I'm like, okay, I'll get my license. I'll scoop an extra commission if there's a co-op available. Did not realize I would turn out to be a successful broker in DC. So people always ask me like, why was I at Coldwell Banker Commercial? I'm like, look, I was just looking for a good split, somebody who had co-star. I was not expecting anything else. But at the time in the Mid Atlantic region, we had like about 2,500 agents, uh, over 20 offices. I think we've definitely dwindled down by the time I left. For consolidations, like residential real estate companies were trying to be lean. But
Mhm.
I would get referrals left and right from these residential agents because, like, look, if there's 2,500 agents, let's say the 24,550 were residential. I mean, look, we had less than like 20, 30 commercial practitioners, and I would get referrals left and right. And then, yeah, it happened kind of by accident. I mean, I got licensed for a different purpose. And then I was starting to make all this money. I'm like, man, like this is like some good side money.
Mhm.
Um, and yeah, it became like a full-time career. And well, it's funny, it's probably two full-time careers now because I am still involved in the family office. People should know this by now, but if they don't, so like on social, like it's very New York heavy, concentrated information I post, but you may see some DC related stuff in there. The reason why is because I am in the city 3, 4 days a week and then I go home. So I split my time back and forth. Because I have this and then I have the family office along with like my family and stuff back home. And I have way more space back home than I do in the city. So I had people ask me like, again, if you follow me on social, like, oh, what you do with all your cars when you move to New York? I'm like, what are you talking about? I still keep them in DC and drive them. I can't even drive them. I can't even drive them in the city. There's no point. It's cheaper to Uber than to pay for all those parking spaces.
It is.
Um, but yeah, and then how I ended up in New York. I started social media back in January 2023, where I was actively posting. That was the same time my boss and my friend Bob Knackle was posting. We became good friends via social media. Then we met in person. And then, of course, Bob got fired by JLL, which that's a whole nother thing. And he was starting a new shop, and I thought I could use a challenge. And I said, all right, why not start a new market? Nothing's tying me down. It's only like a 3.5 hour train ride back and forth DC. It's not a big deal, which people are shocked I do it every week. Um,
Mhm.
and that's how I'm in New York.
Just following up on that, do you think that there's a particular, like, is there a particular reason or example or like I'd love to know more about the thought behind why New York, like why you made the switch to start a brand new market? Because I know a lot of other brokers feel tied to the markets that they're currently working.
Here's what I will say. It is not easy at all.
Hmm.
Like it depends on your career, right? Like my one of my team members, Jazz Saney, came up with me, but Jazz is like in his like mid-20s. Like
Hmm.
he can pack up and leave. Versus me, I'm in my mid-30s, like, pretty established, making like consistent fees over and over to qualify for SIWR and whatnot. I think it's because I had the safety net of the family office because brokerage, look, I make great money doing brokerage, but it's not my, and when I say great money, I mean like it's usually like top 1%. Like I forget what that is, but like, like look, in DC, like to be an SIOR, you need to make 400,000 gross fees every year. In New York, it's 500,000. I just wanted something new to try and like, because look, I was more of a lower transaction amount, but higher volume broker where I was doing probably 60 to 70 deals at my peak. Probably in a bad year was more like 50, 60. But like I was a deal junkie, grind, 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 grind. Versus New York, it's yeah, you do like 4 or 5 deals. Like, look, I closed one deal last year, like 21.34 million. I got like two other deals on I got two other deals I'm working on contract, another one that's getting close, but like I was used to the high velocity versus, you know, doing very, very big 8 and 9 figure deals, but like maybe close one every 3, 4, 5 months.
Hmm.
So, but I mean, look, it was something new, and I wanted a challenge, and I said, like, look, I got nothing tying me down. I think that was the purpose. Like for a new broker to move, I mean, look, we have people in our shop that came from all over the country, from like Florida, Louisiana, and whatnot. They left their successful careers. I will say, like, it is a benefit working for Bob because, like, if you're in real estate, you should know who Bob is, which most people
Mhm.
do. Um, but I mean, look, like, but at the end of the day, like, unlike, when I was in DC and I, relied on CoStar comps and my transaction data and stuff. No, we had to like literally research every single deal, like
Mhm.
what was the buyer, who was the seller, like what was the use? Was it an investment? Was it redevelopment? Was it a user deal? Um, you become like top of your market when you know all that stuff, and people are shocked like how much I know about the office market in Manhattan, and then they find out I'm not even here full time. Like I'm here like half the
Mhm.
week.
Yeah, and I think that's very interesting. That's a good point to talk about like reinventing yourself, especially with the firm that you're currently at. It's clear that you guys are curious and wanting to learn more, and I think it's very it's very noble to be able to say like I even though I am established in a different market, I'm somebody who still wants a challenge, and I think that's very cool.
Well, the other thing I would say is because like I do get business referred back to DC because once they find
Mhm.
out I'm still like like on the family office side, I'll even get like principals here that are looking the JV and whatnot. And I would say like unlike the other people that might have moved from other markets, DC and New York. I mean, look, those are two like out of the six primary gateway cities, those are two of the six.
Mhm.
So and look like like even some of the owners like like the New York guys may own stuff in DC and vice versa.
Mhm. Yeah, well, thank you for the insight. I think brokers who will be listening to this will also appreciate that too. I do want to get into some questions about lending, capital, and debt. I know that when we talked a couple weeks ago, we talked a little bit about this. My first question being, so with high interest rates and tighter lending standards, what creative ways have you in particular seen people getting deals still done?
I mean, look, I've seen some sellers where they bought while it was going down the dip that they're willing to, give their loan might be assumable. They will be willing to give owner finance. If you're on the buy side, I mean, it's kind of has to do with the math, right? When you look at 2020 to 20, like now, 2026, you know, let's take all the office buildings below 60th Street above 20,000 square feet. In 2020, it was like 1,041 a foot. And the lowest it's ever been was in 2024, where it dropped down to 492 a foot, which was a 52.7% decline. And like if you look at the stats, like so like 2020, it was again like 1,041, 2021, 906, 2022, literally like a quarter coin over $800. Like it was 825 cents. Then it dropped to like 781 a foot. Then it massively plummets to 492. And if you look at 2020 to 2023, the average amount of transactions was anywhere from 16 to 25 transactions, and the number of square footage sold was anywhere from like almost 2.3 million square feet to like a little over 4.1 million square feet. In 2024, it jumps up over 40 transactions, like literally 41 transactions, 9.6 million square feet. But then you have this huge drop. If you look at the loans that were issued 2017, 18, 19, coming due in 2024, which are the 5 and 7 year loans, look like you couldn't sell it for what they were worth. The lenders had to dump it. I mean, look, 18 out of those 41 transactions in 2024 happened in the last 4 months of 2024. Now, good news is in 2025, we're at 51 transactions. There's actually a comp I may need to add because like it was labeled as retail, but it was really office. I know this for a fact because I'm doing consulting work on it. I mean, square footage is like a hair under 9 million square feet versus 9.6, but price per square foot went up 578 a foot based on that same metric of like below 60th Street, above 20,000 square feet. The reason we use the above 20,000 square feet because Um, if it's anything like under 20,000 square feet, it might be an owner use deal, which somebody will pay a high price, or a redevelopment site. So, I mean, look, you went from a 52.7% decline, you shot up 17.4%. Now we're at a 44.5% decline. Here's the other thing. So during COVID, I would say Class B office buildings, let's say they were like 70, $80 a foot, like at the time. Like, no, they plummeted to as low as like 30. I mean, now depending on the area, let's say Garment District, depending on where you are in Garment District, which honestly that's more like B minus C buildings. But like, okay, like it'll probably be around, I want to say 30. If I can't see 40, like if you're on 8th Avenue or something. But if you're in like Flatiron, 50, $60, no problem. If you're in NoHo, like 70, $80 a foot, no problem. But when the biggest problem was when you were trying to sell these office buildings, price was here, rent was here. I mean, look, the peak amount of vacancy in New York was 100 million square feet. Before COVID, depending on the publication source you read, it was anywhere between 48 million to 52 million square feet. And we shot up to 100 million square feet. Now look, there's good things that are like causing like one, there's this return to office thing is forcing the supply is not as strong as it used to be. So like when you're losing supply and then the tenants are thinking, oh, I better lock in this rate now before it gets creeps back higher and higher because there's no way I'm going to get this rent in God knows when. So that's one. Two, you gotta look at like all the buildings being converted. So like right now, like we track every single building since COVID, which is 2020, and like there's 86 conversion projects that like are pending, active, whatever, and we usually break it down based on potential is all right. We saw an article, it said it was sold. The buyer made a quote saying he's converting it. Pending is okay, you find out from the owner or publication source, whatever, they're filing plans and they're going through this process. Active is okay, I'm actively converting it as we speak. And then finally, like completed, well, that should be obvious. Like the building's complete now, we're going for like condo sales or rental units. So as of right now, like when you look at the bucket of like just all conversions in New York, based on our internal data and everything we've tracked, we're talking about like it's literally a hair under 28 million square feet. It's 27.996 million square feet. Now, if you look at the office to resi pipeline, so like, and the reason we have two different pipelines, because like, let's say somebody's converting an office to a self-storage building, or let's say somebody's converting a hotel to residential. Like, that's why like we have this master conversion list. But then when you have the office to resi pipeline, and this one might be a little bit out of date because I noticed a deal that's on here that should be updated. Um, so we're missing one deal on here, but it's 22.15 million square feet. So think about that's one thing that's taking supply off the market. Two, New York had its best year for leasing activity. I read one publication, it said it was like 38 million square feet. I read another publication, it was 41 million square feet of leasing activity. So I think we're slowly getting back. I mean, look, like this is like new leases, it doesn't take into account the absorption, whatever like the difference is. But if you're talking about, 22 million either being completed, active, whatever, you're going to take that away from the supply. You're talking about all this push back to the office because they realize, look, working from home was great to a certain degree. I think we're probably more in this hybrid mode where, like, okay, you need to be in the office like 3, 4 days a week, but you probably don't need to be in the office like 5 days a week. Like, look, Bob's in the office like 3, 4 days a week. I'm in the office 3, 4 days a week. But sometimes you need your quiet time too. Like if you came by our office, like we are like bursting at the seams at this point. But back to your original question about like the lending. I mean, look, rents are now at the point where they are in line with office prices. So that's one. So like now it makes more sense for conventional lenders. But I mean, look, like unlike other markets, like New York is very cash heavy. It's not like DC, where like DC is a lot more institutional buyers. in New York, you'd be surprised, like these 20 to $100 million buildings, Bob will say that probably like 90% of it is like private capital. We're talking about like these multi-generational families that are sitting on cash that can execute these deals. Or like a few families might partner up. So like they'll probably buy the building first, get the debt later.
Hmm. Yeah, I was just going to say, I do want to talk more about conversions too. So I'm glad that you brought that up because I know that you have a lot of insight on that. But just a
Yeah.
follow up too about something you mentioned earlier. So can you talk a little bit more and clarify like expiration of debt that originated during these low rate periods and how you're seeing affect all of this?
I mean, look, like I first it has to make sense. Like if the like some lenders, which like during COVID, like they would like blend and extend. Like let's just make this work. Like now's not the time to repossess. But we're at the point now where like lenders are willing to take back a building. I mean, look, I can't give too much details on a deal right now, but I'm looking at a deal where there is a renewal option for the loan. It's like 2 years. Um, it's like 250 basis points on top of the 5-year treasury. But what kills it is it's on a 15-year amortization table. The lending might be difficult at that point, but we're probably seeing more when you're in these tough spots and you don't want to sell is like a recapitalization, like where you'll see somebody come in and say like, hey, I will come in, I will contribute X amount of dollars, but I want this much stake in the building. We're going to recap the building. The original owners will dilute their shares, but it's better than losing the keys back to the lender. So you're seeing
Hmm.
like more creative financing. But I mean, look, like most office owners in New York, I would say like they've actually weathered pretty well. Like most of them weren't crazy with their debt. I mean, I was talking to one family, they had about like a little under $80 million, like with their 4 assets, but they only took out like 28 million in debt. So if you look at the loan to value, that's like nothing. I mean, what is that? Like if you do, what is that? 80 on 28 million on like let's just say 80. So 28 divided by 80. I mean, look, that's only 35% equity they cashed out.
Hmm.
And you would actually see it across the board. I mean, look, I talked to one family office, like they barely had any debt. They were smart, like throughout their whole portfolio, when COVID hit, they knew it was going to be difficult. So instead of like waiting for these leases to expire, they started renegotiating with the tenants right away. They say, hey, we'll
Mm.
give you X month free rent, we'll reduce your rent to this. And like, look, like now they're sitting in a sweet spot.
Yeah, what I'm hearing for you is people are creative. People didn't take, well, you have some instances where people didn't take a lot of risk, but
Yeah.
maybe that's less of a concern because people are still going to get deals done if there are deals to be done.
Well, I mean, look, like that office deal I just told you beforehand, like we have no debt on that building. Four partners, we all wrote a check for about the same amount.
Hmm.
Like there's still enough capital going around. I mean, look, and like again, like I think what more people are doing is buying the deal first with cash and then source the debt later in New York.
Hmm. Yeah, very interesting. Very cool. So, and I do want to talk more about conversions. I know that we talked a little bit about it a couple weeks ago.
Yeah.
I'd love to get your thoughts more on repurposing office spaces into mixed use spacing. Do you feel like this is actually a viable solution, especially for New York City?
Yes, because you have two things. We have one thing working against it, which is 485X. So the reason development hasn't been robust for a few reasons. One is the construction cost, one is like, lending rates are high. But the other thing is if you build over 99 units, they have like a zone A, zone B, and like zone A, I'm pretty sure is like all of Manhattan below 96th Street, and then like the Gold Coast of like Brooklyn and Queens. But like if you're in prime Manhattan, and I think if you go over 100, like if you're over 99 units, my understanding is like somewhere around $40 a foot. Like you have to pay like prevailing wage to union labor for that's doing the construction. But if you're over 150 units, you're at like $72 an hour. At $72 an hour, that's even the guy who flips the sign on the street is getting paid that. And that doesn't take into account like your master plumber, your master electrician that's getting paid like $200-300 an hour and whatnot. So that's one thing working against the new supply. What's working for the conversions is 467M, which when you convert any commercial building, excluding a hotel, into a rental building, you get 3-year tax abatement on your property tax. And depending on when you swing your hammer, like, so I believe it's July of this year, you need to swing your hammer. Um, you'll get like 35-year tax abatement, and then 2 years after that, it'll be only 30-year tax abatement. And then I believe it's 3 years after that, which is the final one, you get like 25-year tax abatement. So, and then you don't have to pay prevailing wage. So and then of course, City of Yes, which made things a lot more doable with like, increased density and zoning. You have Midtown South rezoning, which is in like, the buildings that were zoned in manufacturing districts, which really are office buildings, got changed now to residential zoning. With all these initiatives, like it's forcing, I mean, look, I was talking to a major institutional developer last month. And before he says, no, no, we're not like, my CEO says we're not doing any office to resi. And then he called me and he said, hey, Faraz, like, do you have any good office resi project? And I said, you just told me a freaking month ago that you didn't want to do it. It's like, yo, but we realized we realized that 45X doesn't work. Only way this works is 467M. So that's why we're looking at conversion projects. So I mean, look, even the big mega institutional developers. I mean, look, I was writing up a post on 5 Times Square. That was like a historic Class A building, trophy A building for the longest. It's being converted to 1,200 units. Like work has already started. I think actually it might be completed now. Like I was literally writing up, but like I know it's like close to completion now at this point. Either it started or it's completed. I don't know. I have to like track, but actually I can tell you right now, 5 Times Square. We're gonna do this live. It's starting right now, and we're talking about 1,250 units. And we're talking about a building that, if I remembered right, was almost 1 million square feet.
Well, what do you think will factor into like the long-term viability of these projects? Like, what do you think will make this successful in the long run?
New York has historically always had a supply issue. The only time rents have went down in recent history was during COVID, when there was a mass exodus from New York. I mean, look, I'll give you an example. There's a conversion project going on in Midtown South. The developer is converting it to 107 units, studios. They're
Hmm.
all studios. You know, again, the same institutional developer I'm talking to, like we were talking about this deal. He's like, no, we've all came to the conclusion, if it's in Manhattan, you build it, people will rent it. Like
Hmm.
it's one of those stuff. I mean, look, I was looking at a student housing building for potential conversion because like it was a weird dynamic where maybe we could sell it as condo development or something. But I was touring like student housing, and the guy's telling me they're renting beds for 1380 a month.
Hmm.
And I'm looking at these beds. They're bunk beds, first of all, and the rooms are like probably like twice the size of this office I'm in, like, which I'm not in a very big office. And they might have crammed like 4 to 6 beds in each, like literally it looked like it was a studio that got cut out into like a 2 bed with like bunk beds.
Hmm.
And we're not talking about a great neighborhood. Like I mean, look, it's East Village, it's near NYU, but 1380 for a bunk bed, like. So I think, look, rent right now for a 1 bedroom apartment, I've seen it fluctuate. One number I saw was like 4,500. I've seen it as high as like 4,750, and that's for a 1 bedroom in Manhattan. If you go
Hmm.
to any other market, I mean, look, like you could probably get a very nice, decent sized home for almost 5 grand a month versus a 1 bedroom.
Hmm.
So at the end of the day, I think that the reason why it's viable is we have such a short housing. There's not enough housing supply, and then the other problem is with multifamily and stabilized units. I mean, look, you see like in the news and everything, landlords aren't fixing up these stabilized units and everything. The problem is like when you put in work into like all these like renovations, and you apply, you try to recapture what you should raise in rent. I forget what the breakdown is. I think it's like 1/40th or something. It's, like that's not my per se expertise, but all I know is the amount you can raise versus the work you've done doesn't justify doing the work. Then you're talking about potential rent freezes in stabilized units while expenses are going up, not like 2%. We're talking about more like 3 to 5%. I mean, now it's kind of slowed down, but at one point, like the expenses were going through the roof. There's an estimated, like depending on the publication you're reading, there's an estimated anywhere from 60 to 80,000 units sitting empty in New York, not being rented. And it all comes down to supply. So do I think this is viable? Yes. Like the only way people keep wanting to move to New York and we need more units being built.
Yeah, so I have a very similar question for you as well. Not just about multifamily and residential, but just asset classes in general. So, in your opinion, like what asset classes are facing the most pressure, especially right now? I know that a lot of people had opinions about office versus retail in the last couple of years. I'd love to get your thoughts.
Office is definitely bouncing back based on the stats I've told you. Like we're nowhere close to 2020, but we've seen signs that we've already hit the dip. The dip was 2024. Every office owner I've talked to said 2024 was by far the worst, and we're out of it now. Multifamily, it depends on who you're talking to. If you're talking to somebody who's lived in New York forever, and then the 2019 rent stabilization laws came in, and your multifamily is no longer worth like a 3 or 3.5, 3.5 cap. Now it's like 5 to 7, and you're now worried about this mayor doing rent stabilization. You're probably going to want to get out, sell, and 1031 something else. But then you have the other group of multifamily buyers who are like, great, I'm still active in New York. I'm going to buy stuff on a Momdani discount. I've heard a few people. So it depends on where your thoughts are. I mean, look, rent stabilized is probably going to face the most pressure because, like, the rent regulation boards that, the guideline boards that set the rents for rent stabilized, they could freeze rents because it did happen during de Blasio. Retail, surprisingly, I was looking at because I'm working on two capital markets retail deals right now, both like very high occupancy, like 80, 90%. As long as you're in a good location, solid tenants. Look, I've seen some retail deals in New York still trade as low as like 4 or 5 caps. But I would say, like, depending on your tenant mix location, I mean, look, I'm working on another deal where it's like more mom and pops. Like, we're probably evaluating it between a 6.75 and a 7.25 cap rate. So, but like retail tends to be, depending on your tenants and your location. I mean, look, I'm still seeing like $1,000 square foot plus, depending on your tenant mix and income. All right, we talked about multi. We talked about I mean, those are usually like I would say industrial, but the problem is in Manhattan, if you can imagine, there's not enough product type for even to consider. Like, look, most of the industrial spaces are either in the Bronx, they're in Long Island, they're out like way far in Brooklyn or Queens or in Jersey. There's not really much like in Manhattan when it comes to industrial space in the first place. So I can't really speak about industrial in Manhattan.
That's okay. I have a great follow-up question. You mentioned working on specific retail projects. Have you seen any specialized retail in general or heard about specialized retail that's performing especially well this year or expected to perform really well?
Um, Specialized retail. I think it still comes down to your credit tenant mix. Like of course, if you have better credit tenants, like they'll definitely trade at a premium. Location's very key in Manhattan. I mean, look, I will track deals and like people are very unlike other markets where it's like very like cap rate driven. In New York, I would say it's more price per square foot driven before cap rate driven. So like people like they're willing to pay X amount of dollar per foot. I mean, look, I looked at a deal in Soho, even though it was a 9 cap, it was like $900 a foot. And that's still a little bit on the low end on Soho because Soho could easily trade, to like 12, 13, $1,500 a foot. But No, I mean, again, it all depends on your tenant mix and stuff. I don't know if there's anything. Usually, the buildings that have been making news is if it was sold to a user, like a few years back when like the Prada building was sold for their own use. I mean, there was another building where like Hyundai bought an office building and it was over $2,000 a foot. I don't remember exactly what it was because like it's been a while since I looked at that deal. I would say the top deals that are like making the news is like either retailers or owner users buying their own space for a massive premium.
Yeah, and I appreciate you talking a lot about data and analytics. I would love to know more about what your like what kind of conversation, getting insight on the conversations with your clients. So, what data do they actually care about and they ask you about?
Um, I would say so when it comes to leasing data, I always bring in my good friend Avery from like Okada because like I'm not a leasing broker, but like whenever I need like either Avery or I'll talk to Corey Zelnick at Zelnick and Co. because like he's my retail guy. But when it comes to like comps and whatnot, I mean, like I said, I don't know why, but in New York they really care about their price per square foot.
Mm-hmm.
The multi and retail guys do care a little bit more about their cap rate. Office, it seems like they're very price per square foot. The only time I would say cap rate comes into play is like if we're talking about like a high stabilization, let's say like 90 to 100%, then cap rate will come to play where they say like, all right, because like look, when I evaluate like, depending on the deal, I mean, look, average cap rate. I was doing a portfolio deal analysis, and it was like around like Chelsea, Flatiron, Nomad, and basically the average cap rate was like 7.69. But then when you go further up, like you're starting to see the eights. Like, look, I looked at a deal in like Soho, and I would say average cap rate there was about like 6.34 because Soho is a much more desirable area. But like, I would say on the more highly leased up stuff in office, they'll start looking at caps. But again, they'll still correlate it to price per square foot because then they're going to wonder, because then they'll do the backward math. They'll be like, all right, well, if it's at this price per square foot, but at this cap, what's the story? And then you may find out like, oh, it's the the tenants are paying really high rent. Well, like, okay, well, why are they paying really high rent? So, you have to go through this arithmetic and whatnot. But no, I mean, look, just being on top of your data, I mean, to say this off the top of my head is very difficult. Like usually the office data, I have it beaten down. The other asset types like retail, multifamily, I'll keep track of the comps every week. I'll update it, like go through publications and everything. Like, look, it's easy for me to discuss it here because I have like my three screens and I can pull it up.
Mm-hmm.
But no, I mean, look, as long as you're top of your data, like I like the nice thing about New York, you'll have multiple publication services like Traded, Commercial Observer, The Real Deal, Cranes. And then like in New York, unlike other jurisdictions, so like in my back home in DC, Maryland, Virginia, you can't just export the tax records. In New
Mm-hmm.
York, you can't. So when you can export, like, you can download it by like all right, like these are the neighborhoods. This is the types of buildings I want to export, like office, retail, multi, and it all has its own code. So you have like this whole list, and I'll track buildings over like that sold for over $1 million, nothing that like, was an internal trade or anything, it's like real trades. And then I will literally go like on my train ride every morning, heading to the city for my 2, 3, like 4 day stay. And I will literally like research all the comps like on my train, which like, look, if you do it all at once, it'll take you forever. But like, since I do it every week, but staying on top of all your data and especially keeping it internalized. And look, we'll even go one step further. Like, I'll call all the owners. I'll say like, hey, verify trade. What was the use and all that. Same with the conversions. I was like, verify. I was looking at somebody else's report and they had like 120 some buildings slated for conversion. I'm like, that can't be right. So I started calling these owners, and it's like, no, at one point we were, but then we decided not to. So it was a lot of old
Mm-hmm.
data. And I said, like, all right, it's like, so I'll still keep it in my database, but in a separate sheet, like, okay, they were considering it, but it's no longer being there. And this is like old data.
Mm-hmm. Yeah, and I appreciate you. I mean, I've been in the data CRE world for almost 4 years now, so it's always interesting to get different brokers' perspectives on how they keep up and keep up to date. I do want to talk a little bit about like what we're doing at Hubexo and like planned construction data. So I would like to get your thoughts on if planned construction data, like how important is that to your clients and how you're using like information about conversions or new developments in New York City, like how you're using to leverage that in conversations with your clients.
Well, I mean, look, like we use one tool called like Property Scout, and we also use like DOB filings and whatnot. Like Property Scout, like kind of gives you, which is if you don't know what it is, like it's a very New York thing. It's not a nationwide thing. It's just a very New York thing. But no, like you go through Acris through the DOB filings, you'll see like I would say like when it comes to the conversions, you definitely need to know about it. It's also helpful because like when you're selling a building, you need to know if there's any violations outstanding, or if there's any local law 11 work that needs to be done, which people who are not from New York don't know. Local law 11 is something that needs to be done. I think the cycle is every 10 year. Like I should know this, but I don't. But like usually there's a cycle in New York where you have to get the facade inspected X amount of years. And you need to then like, do the work. So like the reason behind it is because like back in the 70s, somebody was killed by like a falling crushing piece of like concrete.
Mm-hmm.
And they enacted like local law 11 and to prevent like these accidents. But the reason why you see like scaffolding in New York all over the place, because let's say the local law 11 work, it costs you, I mean, look, I've seen one local law 11 work where it just cost like $500,000. I saw another one that was $3 million. I saw one that was like a historic building that was like all terracotta and stuff. That was $7 million because they had to get the terracotta made in South Carolina and then shipped it up here. Um, and think about it, so if you're spending that much versus, you know, I think the fine, I know they raised the fine. I don't know what the old fine was, but the old fine was like, I think like what, like 1,000, 1,500 a month versus, paying hundreds and hundreds of thousands of dollars. That's why you see all this scaffolding in New York. But when you come time for sale, like no, it's going to discount your pricing because then the owner is going to like, well, you have all this local law 11 work, you have all this violations, like you didn't close out these permits. So no, it does affect like the capital markets sides of the sales when you don't have like, and you need to be up to date with this construction data because if you're not, then somebody's going to find out later on, and then your evaluation might be all screwed.
Yeah. I do have a couple questions as well about, while we're still kind of talking a little bit about policies. I know that you and I talked about COPA. I'm not privy to it, but I think that you will have something interesting to say about anything that's currently affecting multifamily, especially in New York City.
Well, COPA as of right now, which is interesting, Mayor Adams vetoed it within like the 11th hour of like the 59th minute. Like I think like I remember seeing the Real Deal article come out like maybe around like 4 or 5 o'clock. It was like January 31st and he vetoes COPA. I just saw an article too, like maybe last week where city council can't get the votes to override the COPA. But I know they're going to try bringing it back again. But for what people don't know what COPA is, it stands for Community Opportunity to Purchase Act, which is very weird. Like how, like this is how COPA should normally work. Because like I see it in Montgomery and Prince George's County where I'm from, like in the DC area. So like we've dealt with COPA. My colleague Brennan, who works under me, he's originally from San Francisco. They have COPA. But normally what I've seen like in COPA, like it's like let me give you an example like where I'm from. You go to market, you get the bids, then you go under contract, but there's a ROFO provision in there saying the county has up to a year to, execute the deal with the same terms. Usually it takes 6 months. It doesn't take a year. It's very rare a deal takes like a year. But the county's not going to actually buy it themselves. Like they will fund like a nonprofit to run these buildings and for like affordable housing, whatnot. What they were trying to do in New York was add another step. So again, like this is what from what I've heard from my multifamily broker colleagues, because again, like my specialty is office and the other stuff is like secondary. But usually you what you would have to do in New York, what they were proposing is, all right, you get your BOV, you get a broker's give you, your opinion of value, and then you go to, New York and like say like, hey, you go to NYCHA. NYCHA is like, hey, here are my, like this is what I want. They will go to their whole like nonprofits, that. And my understanding was like it was like up to 4 months if they would offer on the deal or not. If you didn't get an offer, then you go out to market. Like so before you even went out to market, you have to like put out, and usually everybody will try to shoot high because you don't want to sell it low and then you found out the market could have paid you higher. But by doing that, okay, let's say you go to market and then you get like you finally go under contract. Well, if it's lower than the price you offered like New York City, they have a second round to enact their ROFO to like match the terms of that buyer, which could add another 4 months. So like you're talking about like 8 months additional easily on the sales cycle. Now, I'm speaking as somebody who has dealt with it. Yes, it will delay the cycles of the deal and it may kill some deals because, people in like 1031s, whatnot, because like, they can't be waiting this long, it might be exceed their limit. So I understand that point. Will it kill the market? No. I see top brokers in San Francisco still doing it. Like in my area, deals are still happening. Will the sales cycle be a lot longer? Absolutely. It will be a lot longer. So have more in your pipeline because stuff is going to take longer to close.
Hmm. Yeah, I hear you. I do want to spend a moment to one of our last questions too. So about something more like environmental and green buildings because of our partnerships that we have. So I'd love to know if you've heard anything about like ESG helping enhance competitive positioning, or like what are the cost benefits of investing in green buildings potentially?
Well, in New York, it's going to have to be a thing. So if you are not aware, let me pull this up. So local law 97, right? It says like the first compliance period came out in 2024. So literally 2 years ago.
Hmm.
And basically the goal is they want 70% of buildings, like the carbon emissions from the buildings, to use like basically they want to be net neutral by 2050. We're talking about buildings that have been like 1800s, like late 1800s, early 1900s. Um, I mean, look, like that's why you hear in New York, like, oh, is your apartment pre-war or post-war? I mean, look, like it's a very, very, very expensive initiative for New York City. It's not like we're building new buildings left and right. Like we're talking about retrofitting. I mean, look, like even like, when I look at buildings, it goes like, oh, what kind of oil are you using in the boiler? Are you using number 6, number 4, now number 2, which again, I'm not an environmental person, but my understanding is the closer you get to zero, the better the fuel quality of the oil is for environment. So it's not a possibility. It is no. In New York, they have to be, like if they're over a certain square footage, like they have to be like carbon neutral, assuming the law stays intact. The interesting thing is though, the only exemption is any buildings owned by the government.
Mm. Yes.
which
Yeah,
which
somehow that
which
doesn't
which
surprise me.
yeah, so it's not a like if, it's like no, they have to.
Hmm.
So I think people are gonna have to figure out ways to be cost effective to, revitalize these buildings to make them compliant, because it's not gonna be an easy endeavor.
Hmm. Which is very reminiscent of a lot of our conversation today already, is like people need to be creative, period, especially on the East Coast markets of how to get deals done.
Yeah. But yeah, I mean, look, I know it's more common because like where I'm from in DC, you see a lot more lead silver, lead gold, leads platinum. I mean, look, the only time I see that stuff is like the new development stuff in like Hudson Yards or One Vanderbilt. But like a lot of the product we're dealing with is definitely pre-World War II.
Hmm. Yeah, which is much different than a lot of other markets, obviously, across the
Yeah,
state. So I appreciate that perspective. That's very interesting. I didn't know any of that. Um,
yeah.
well, very cool, Faraz. I'd love to give you some time if there's anything that you want to say about things that you have going on before, we say goodbye to you, or yeah, just to close out.
I should be more active on social. Let's see if I'll actually. I made that as a 2026 resolution. Let's hope I keep up with it. I think I've been good so far for the last 2 days.
That was very cool. I think that was a very insightful conversation. I think it's really cool to get, especially your perspective being in New York City, and there's a lot of changes that are happening in the city. So I really appreciate the conversation. And yeah, thank you so much for your time. That was really fantastic.